Welcome to a special edition of the Marketplace Roundtable podcast featuring J Mintzmyer of Value Investor's Edge. Jay first began contributing to Seeking Alpha in 2011, building up a large following through his work covering shipping stocks, probably about as comprehensively as they're covered anywhere online or in print. Since 2015, Jay has run the Value Investor's Edge marketplace service here at Seeking Alpha. The service offers intensive coverage of deep value opportunities in the shipping, energy, MLP, and industrial sectors. You can subscribe to Value Investor's Edge by going to seekingalpha.com and typing J Mintzmyer, that's Mintzmyer, or Value Investor's Edge into the search bar at the top of the site. Before we begin, a brief disclaimer. Seeking Alpha is a website where authors from around the world share their ideas and analysis on the stock market. The marketplace is our platform for authors to run investing analysis and idea services so that readers can take their investing to the next level. Nothing on this podcast should be taken as investment advice. And now your host, J Mintzmyer.
All right, good afternoon, everybody. Welcome to another iteration of Value Investor's Edge Live. We're recording on the afternoon of June 11th, 2021, about 2 o'clock Eastern Time. We're hosting International Seaways. The CEO, Lois Zabrocki, and CFO, Jeff Pribor. They're here to talk with us about the crude and product tanker markets, both the markets overall, the different dynamics, what's going on today, as well as a little bit more specifics about International Seaways, the company. They're undergoing a merger with Diamond S, which is stock symbol DSSI. Hopefully that merger will be completed in Q3 upcoming. We'll talk a little bit about that today and get some more color on the deal. As a reminder, nothing on the call today constitutes official company guidance or investment recommendations of any form. I do have a long position in International Seaways, stock symbol INSW. This is a recording on June 11th, so if you're listening to this at a later date, just make sure you look up those latest disclosures. With that said, Lois and Jeff, welcome. Thank you for joining us today.
Thank you very much, Jay. We're happy to be here.
Our pleasure.
Absolutely, of course. So we'll get right into it then. We're just going to jump in, talk about the crude tanker markets. There's been a lot of, well, it's been a roller coaster, right? There was a lot of the fun last year, a lot of good times. They had you on TV talking about how awesome the tanker markets were, and that was a fun little run. You got some time charters done, but the last 6 to 9 months have been a lot of misery, a lot of stagnation in the market. Have we passed the worst of it yet, or is there still a little bit more volatility to come?
Well, Jay, I would say that, even when, the market was running, you knew that there would be a bit of the hangover where the stock drawdowns had to happen because that huge bull run was not because of, rocketing oil demand. It was COVID related, and the fact that there was too much oil and it needed to be stored. That having been said, now, past the inflection point. So from an asset value perspective, and it's a little different for multiple different pieces of the market. The fourth quarter, from a new building price perspective, was the low point. And, when we talk about our new building Shell VLCCs that we're building, that comes into play. And then, on the product carrier side and the crude, that's true on a new building perspective. And then from a second-hand value perspective, I would say, somewhere in the first quarter, it's really, kind of a bottom. But on the spot rate, you have not yet seen the pickup, the anticipated pickup come through. And you do see oil prices increasing. You see, the International Energy Agency projecting a big pickup in the second half of oil demand, really an unprecedented volume of change from where we are today. So, maybe from a spot market perspective, second quarter would be the bottom is what we're thinking.
Okay, so it sounds like from a spot market perspective, we might still have a little bit of work to do. We're still, in Q2 and maybe a few more months of that, but it sounds like from an asset perspective, as far as both literal steel values with the new builds and the resales, but also with owners and participants getting more excited about the current on the water assets? Sounds like you're saying we've already turned around on the asset side, and that gives you encouragement. Is that fair?
Absolutely, absolutely. That is indeed what we are seeing, and it did flow from I mean, commodity prices are rising. The steel prices have risen, and all of that flows into the new building cost. And then I do believe that you're seeing people anticipate, okay, let's get some more ships before the market really starts moving.
Yeah, it certainly makes sense that you definitely want to be buying assets, a couple quarters ago, or maybe even today. You don't want to be, trying to buy tonnage when the rates are going wild. And of course, we've seen, that happen in totally different markets, of course, but we've seen that happen in container ships. We're starting to see it happen in dry bulk. Once those rates move, especially the charter rates, the assets, of course, are gonna follow. So in this case, it sounds a little bit like some speculative asset moves that are hopefully precursing the spot move. So you're becoming a major player in the product tanker sector now with this Diamond S merger. Your product tanker fleet was a lot smaller before. It was regional trades in the LRs. You had a few MRs. Now you're going to be a major player in the MR market. Can you talk a little bit about the outlook for product tankers? Is it different than crude? Is there different stuff to look at?
Well, I always say that they're very linked, but of course, that's from a super macro level. When you get into the specifics of each vessel class, so indeed, we will go from having 4 MRs to 54. And that product carrier market, you see a lot during the pandemic of pressure on different refineries. And, Australia is the big example where they've closed so many refineries and they're truly importing the majority of their needs on the oil side, right, on the product carriers. And some refineries have closed, and you also have additional refineries coming on, in the Middle East. So you're seeing the product carrier ton mile demand likely to grow at a faster pace than that on the crude side. And so, doing, a result of the merger, we still feel that the fundamentals are, very strong on the V's and the Suez, and those will be the barbells where we have a lot of strength. China and India, emerging markets, that growth that we need on the crude side, I still think that largely that'll come from the East, and those are long ton mile moves, but it's sort of, dovetails. You're going to see the market start to go on the product carriers, and we also think the crude fundamentals will be quite strong and that we're set up very well for the market to recover.
Yeah, well, we'll certainly hope so. And of course, the long-term correlations are fairly tight, but there's sometimes a month or two, or sometimes even a quarter or two of
could be
lag.
6 months, yeah, where that happens. But when you see GDPs projected to be worldwide over 5% in 2021, and oil demand being a derivative of that, you're set up for a positive scenario in both sectors.
Definitely makes sense. One thing we're watching really closely is the jet fuel consumption and travel volumes. And of course, you can usually the energy information numbers and some of those other numbers are a month or two behind the lags. So we're trying to watch, air traffic volumes as sort of a leading indicator for that. But is there anything else you can watch? I know you mentioned GDP. Is there anything else you're watching out there for the product tanker market?
Yeah, the refinery margins. Looking at, say, for example, the U.S. Gulf, you see utilization rates for the first time in a couple of years popping over 90% last week. And, looking at, okay, you're starting to run that product through in anticipation of demand. So, we look at those refining margins to be positive, and to see that product not only being consumed in the U.S., but a lot of diesel being pushed out of the U.S. Gulf down into, South America and Europe, and then we're seeing the gasoline coming from Europe to the East Coast, some of which was a little bit spurred by the Colonial Pipeline outage, and then has gotten a little bit more traction. So on the product side, we do tend to look at all of that and, your overall inventory levels in the world as well.
Yeah, certainly a lot of things to look at, but it sounds like we should add a little bit more of a refinery utilization as well as one of the things to track. So before we turn to a little bit more company specifics and some of the niche questions we have there and around the merger, I want to talk big picture a little bit about upcoming environmental regulations. There's been a lot of talk about the 2023 EEXI standards. There's also been proposals for some sort of bunker fuel tonnage tax in the next few years. Just a proposal on that front, but the EEXI looks set to start in about a year and a half here. So how does that impact International Seaways, and what are you doing to position yourselves for that?
Absolutely, Jay. I mean, IMO is in meetings while we speak, on many of these measures, and looking at, we would love for IMO to come out with a position so that the world does less bespoke regulations for specific areas. So I think that would be better for all of us in shipping. People say, you want a level playing field, but if you do have a set of standards, then you have a specific goal to aim for. We feel like doing the merger that we're doing, you come out and you've got a market cap of $1 billion, and then you get the attention of larger investors, and your stock is more liquid. And the way that kind of all comes through, yes, the regulations are coming, and there will be a lot of research and development that's required. And I think that when this starts to happen and you are undergoing a period of rapid change, it's very good to be a little bit bigger and have this enhanced skill set in-house, where you're looking at, okay, what it will be the fuels of the future, and what will that ship look like. And, we want to be at the forefront of that, Jay.
Yeah, certainly you have to keep both eyes open, and you want to be ahead of the curve there. How will that impact some of your older tonnage? Because you have the LR1s that do regional trades.
Yeah.
Some of these MRs you're picking up from Diamond are a little bit older than we might like. How do those impact it?
Well, I guess what I would say is that a rising tide lifts all boats, and the ships, the combined fleet, we will still have a very competitive profile. We'll be under 10 years old on average, and we will look, as we have at International Seaways since we're in our 5th year. We've sold 22 ships, and we replaced those vessels, or high graded the fleet with basically a dozen vessels that will be very efficient and much newer, right? So we'll constantly be looking at the ships and doing that same type of pruning and maximization on the combined fleet. And what I will say is that from a fundamentals perspective, I really do believe that these vessels, that even if they're 11 or 12 or 14 or 15, I really do believe that they will enjoy the run up in the market and earn very well in the next few years.
Yeah, it certainly makes sense. And on an asset basis, like a percentage return on the assets, you might expect those older ships to actually return more, right, into a strong market. The risk, of course, is the eventual divestiture of those. And there's been an increasing focus on green recycling and environmental stewardship and responsibility and that sort of thing. Is there a risk to that when you divest those vessels, where you have to worry about, maybe you won't demolish them, right? Maybe you'll sell them for secondary trading, but is there a risk where you have to worry about what happens to that ship?
Well, what I would say there, Jay, is that in general, we have not kept ships past 20 years, although, the vessels on average do recycle at, probably on average closer to 25. We check that quite often. depending upon where we are in the cycle in the market. So at Seaways, if we do, recycle a vessel, we're going to do it consistent with the Hong Kong Convention, and have that final yard where the vessel would be disassembled be NK class. And there has been a lot of work done by classification societies and these yards to improve and bring up their standards so that that is a viable option for owners. And right now with the commodity market running, you're seeing recycle prices per light dead ship of over $500 per ton. So I think at this juncture, I don't think that that's really a worry, Jay.
Well, we hope it remains that way, but you mentioned the $500 quote, and what's sort of the spread between the green responsible recycling outfit, whether or not that's in Turkey or maybe it's a newer yard in India or whatnot, versus some of the stuff that's a little bit sketchier on the subcon. Like what's the spread between those?
There is a spread. I do think that it's still evolving, and it's not a set amount, Jay. So I think we'll see that develop as more vessels head to recycle, in the coming year.
Hey, could I jump in, Jay? It's Jeff. It's a classic example of the market evolving to where lots of different market forces want to take it, and meaning there's ourselves and other owners, recognizing that we want to do responsible recycling consistent with the Hong Kong Convention. And so people see that as an opportunity. And so there have been more and more players coming into the market to provide that opportunity in a quality way, which results in a better assurance on what you're doing in a narrower spread to just the old let it go on the beach and get broken up. And that's just a classic market response, because more and more ship owners are like us. They insist on doing it this way. So, we're getting the alternatives, and they're increasingly attractive compared to where they were a couple of years ago.
No, that's great, Jeff. And it becomes the standard. In other words, the minimum standard is being raised. And I think that is really important in the market.
It'll certainly be something to follow, and it hasn't really been a challenge for really any company we follow yet, mostly because first of all, these companies have newer tonnage and they're more responsible, they care about their image, and they don't usually demolish ships, and if they do, they usually sell it to someone who operates it for those final tail years. But there's been commentary out there saying that green recycling is going to collapse the demolition market and that sort of thing. But we see the spreads right now. We see mid fives for some of the, we'll call them sketchier destinations, and around 350 or so for some of the cleaner, greener, more friendly destinations. So it seems like there's around a $200 spread currently. Is that number reasonable, or am I overestimating?
I think you're overstating, and I think based on what we've seen, and when you don't want to paint an entire country with the same brush, when you talk about sketchier locations, right? So you used to just that there, I think many of the different countries have spent 2-3 years working on bringing up standards. So I think that's overstating the differential, Jay.
Okay, I think that's, I'm glad that if I am overstating it, because I know it's been raised by maybe even by a few of your high profile peers, right, who have maybe overstated the case. And maybe that's because they have all eco tonnage. Maybe they have reasons to overstate the risk of older tonnage, but it has been a debate. So I'm glad you settled that a little bit with some more color. Any color is useful. So let's pivot then and talk about International Seaways specifically. You're in the middle of this big merger with Diamond S. Real quick, big picture, what was the allure to that? What was the primary thing that brought you out there? Was it mostly valuations? Was it wanting scale? Was it like product assets? What was kind of the driver there?
Jay, I would say it's a combination of all the above, and the market timing, I think, is also a huge consideration in that, where to me, it's similar to when you're trying to acquire tonnage, whether through building, whether through buying secondhand or doing a merger, uh, more optimal to try to bring that combination together when you're cyclically at the low point. And then, as those asset values rise and your earnings from operations rise, you can enjoy the benefits of having that combination. So, you look at it, and Diamond S and International Seaways, we're New York-based companies, and we have similar philosophies, and we will need a lot of the Diamond S folks and their expertise on their ships. And I think a lot of these factors led to the fact that was going to dovetail very nicely.
Yeah, so certainly plurality of drivers there. One of the things that was really interesting was, both of your stocks traded at a significant discount to NAV. Their discount was even larger than yours, but both stocks traded at a discount. You structured the deal in a way. I mean, I've checked the math and looked at the numbers. It's basically a NAV to NAV deal, right? It's basically a fair deal for those assets. And it creates a lot of more scale, like you said. It improves the balance sheet, at least on their side. Your balance sheet was already very good. Theirs had some issues, some warts in it. I think the combined balance sheet's very strong. The combined liquidity is very strong. But look, your stock still trades at a ginormous discount. I mean, it's not just because of tankers, because it's below even tanker peers. So what do you think is going on there with the market and that large discount to NAV?
Well, I think, Jay, that we have been earning our way higher, as we say on the leaderboard, and where we're trading today, which is over $20 per share. We're narrowing that discount, and we think that with the combined fleet and having more scale, we can be a leader in the space. And if someone's going to buy just one tanker company, we think that being a larger combined entity, we can be that company. And, remember that, we were a spin out. And when we spun out, our assets were, older on average. We were about 12 years old. Right now, we're like 9 years old. But in the meantime, that doesn't show you all of what we've been doing behind the scenes, where, and I'm going to have Jeff talk about the debt in a moment, but just from the earnings potentials of our ships, we have, we bought the 6 Generate VLCCs at the low point in the market. They earned incredibly last year. We sold off our non-core LNG joint venture for $123 million of cash. So we've been, and even during the pandemic, we contracted for these VLCCs that are already 10%, I would say, in the money. And now we're concluding the Diamond S merger. So, we're not idle in closing that gap. And we think it was has been a confluence of factors of, needing to high grade the fleet, developing a track record. And Jeff, just as by way of reminder, the cost of debt we had previously and where it is now.
Well, sure, Jay, you know this from the beginning, and I'm sure a number of your listeners have as well. When we were spun off, we had high cost debt that also restricted our ability to return cash to shareholders. So just before the pandemic hit, that was only 15 months ago. Might seem like, or 60, might seem like longer, but just as we got into the end of 2019, beginning of 20, we capped off a big effort to redo our balance sheet in toto to bring us more flexible and much less expensive debt. We saved over 200 basis points in terms of the cost of the debt by bringing it out of the capital markets, Terminal B arena to long-term shipping relationship banks who work with us for our long-term goals, whether they be a merger with Diamond S or returning substantial cash to shareholders. So we've been in that position since the beginning of last year. Well, let me say that a couple things. One is we think that in order to get the kind of valuation that you'd like, some people say, well, just it scale is the most important thing. Other people say, well, it's capital allocation. Lois and I and our team are firmly convinced that it's both. There are large companies in the shipping space that have scale, but are not doing as much with capital allocation to return cash to shareholders when it's appropriate, and their valuation isn't as good. And there are companies that are doing a good job, pretty good job on capital allocation, but without the scale, and their valuations are not as good. I firmly believe you need to do both. And so we started on the track last year of returning cash to shareholders with a share repurchase program of $30 million. It's about 5% of the company, so pretty credible. We stopped for a while while we had material non-public transactions in the works that we couldn't talk about, like extending our FSO is something we haven't got to yet. We can talk about that, but extending it for 10 years longer, the life of our FSO joint venture, and of course the Diamond S merger. So to me, that's kind of like a pit stop on the Daytona 500 to get a new tank of gas and 4 new tires. So we stopped, but now we'll be coming out of the pits as a bigger company with 100 ships, $1 billion of market cap. A lot of ability to be able to allocate capital. If our share price continues to trade well below NAV, well then you bet we'll be allocating that capital to share repurchases. And don't forget, we're giving $31.5 million back to our shareholders in a special dividend. Couldn't do share repurchases, as we said. So at least we are paying attention and doing what we can, which is a special dividend going into the merger. So I think that gives you a flavor of what we've been thinking about and how we're going to look at it going forward.
Yeah, I'm certainly glad to hear both of you address that. And, share repurchases are very accretive at this price. And I mean, they would have been even more accretive a few weeks or a couple months ago, but I realize with the Diamond S merger, right, you're completely locked out of repurchasing. And I think that would also slightly skew the deal economics too, if you repurchased your own float and not theirs, right, based on the exchange rates and stuff. So is that fair? And if the merger's done and it closes, it's supposed to be closing in Q3, right? Is that current repurchase program, does that remain active then thereafter?
Absolutely. It's in place. It's now $50 million. And yeah, I mean, if in a perfect world we could have said, oh, let's dial up share repurchases a couple of quarters ago when the share price was a little cheaper, and just simply ask the folks up at Diamond S to just hang on nine months or so, and then we'll see about a merger again. You could imagine that in your dreams, but that's not the way the world works. We were in talks, and there's an opportunity. You either get done or you don't. And so we're knock wood, going to get it done, and then it will give us that opportunity, as you say, Jay, we'll have after the merger, subject to liquidity, keep an eye on that, as we always do. There'll be plenty of ability to buy back shares. And maybe that's a good segue. Lois asked me to mention the debt. One of the reasons that we are positioned to do a deal like Diamond S and do it at the same time as we announced 3 new building orders for delivery in 2023 of those dual fuel LNGs on long-term charter to Shell. Well, it's back-ended, so as far as the payments go, so it didn't take a lot of upfront cash. But how could we do that? Well, we started the year with liquidity in our company of over $200 million and a net debt of just 26% net debt to cap and a little over 30% net debt to value. So we started out really low levered, and that's been our philosophy. To go back to the beginning, 4 years ago, we said we started out kind of low levered. We levered up at the last cycle bottom in 2018. You recall, Jay, we bought $600 million of ships right around that time, and levered up closer to 50%. And that's our target, or that's our limit. We don't like to go above 50% loan to value, and only at the bottom of the cycle. And then we used the upturn that came, including the COVID bump, to rapidly delever in terms of paying down debt and building up cash to our net debt to value was, as I say, in the low 30s, and our net debt to trailing 12 months EBITDA was about 2. So these are low numbers, and that allows us to do the slight leveraging up that comes with the Diamond S merger. It's not a lot, but they're slightly more levered than we are. So maybe we go into the could go into the 40s, but it's still not even near that 50% level here at the bottom of the cycle. So, by deleveraging and building up liquidity, you give yourself the flexibility to do, transformative deals like this. And then going into the next upcycle, when it comes, you can bet you we'll be leveraging again to give ourselves more, as well as returning cash to shareholders, to give ourselves more optionality.
Certainly, Jeff, and of course, as you know, and most of the listeners here on the call, we followed you closely for most of your company history, so we appreciate what you've done, and preaching to the choir a little bit, but we we love it. It's been a good stewardship of the company so far, so please keep that up. One little niche question there, real quick, and then we'll move on. Is there any potential or an appetite for some sort of like a tender deal, like maybe like 50 million tender or something like that? It seems like there's a lot of slack in these shares, and I know trading float, trading liquidity is a conversation item, but with this Diamond S merger, your trading liquidity and float are going to go way up, and it seems like there's just kind of an overhang and slack in the shares. Is there any way to tighten that up a little bit with some sort of tender offer?
Look, it's like, if I may, Lois, I'll just carry on for a second, jump in, but it's like the difference between strategy and tactics, right? The strategy is, if you're trading below your intrinsic value, which in our case is NAV, as long as you have an eye to the future, you still think you're below it, well below forward NAV, which is definitely the case because asset values are rising. If you're trading substantially below NAV, the thing to do when you can is buy back shares. Tactics, well, whether you buy that in the open market, what we've done to date, or the tender, we look at all tactical options, put it that way, Jay. So it's on the table. We definitely would consider it. It's just a question of how we execute. So
fantastic. Certainly makes sense, Jeff. I just, tenders haven't been quite as common in the U.S. markets, and one of your peers, not a peer in tankers, but a peer U.S. listed shipping company, Dorian LPG, did a tender, and it was just a phenomenal success. I mean, they got excellent share volumes off of it, and they were buying back massive blocks at 60%. 65% NAV. So that was an example of one that worked. We'll have to see in the future, but fingers crossed, hopefully, right, your shares trade up to NAV and above NAV, and it's not even really a question anymore. We can start talking about dividends. On the note of dividends, you have a small fixed dividend, right? 6 cents a quarter. Is there any, I know it's a little premature, but we're just thinking about maybe 2022 when things are better. Is there any sort of guidance, not guidance, that's not the right word. Is there any sort of thought process on, how that dividend could evolve? Would it be maybe more of a fixed dividend or maybe some sort of variable dividend, or do you have any thoughts on that?
I mean, what I would say, Jay, is, right now, as Jeff said, this $31.5 million dividend that Seaways will be distributing represents, something like 5.5%. And we've been consistent with, the 1.5%, dividend that we've been doing per quarter, which clearly right now, most tanker companies are not doing any dividend. And I think that, for us, it's an active conversation that will be had, and continue to be had at board level through the closing, and then, move forward. So I don't think we're ready to announce any kind of change in policy. Are we, Jeff?
No, but no, it's not yet. We look at we look at capital allocation every quarter, and when I say we look at it, we probably talk about it much more frequently, but we review it formally with our board every quarter and say, hey, what makes sense right now for where our company's evolving and where we are in the cycle. We both like, all of us do, having this small fixed dividend. It gives us that option to consider something like you're asking about, Jay, in the future. But, that could rise at some point. Sure, if we were bigger and then we're getting bigger, and if, leverage is down, and it's all a possibility, but we're not, I don't think we're going to lay out a goal just yet. It's nice to have the optionality.
Okay, yeah, that's certainly fair, and of course, my bias as kind of a value investor and longer term focus, and also thinking about tax, realistic tax obligations as well. When you're below NAV, repurchases just look so much better than dividends, of course. But obviously, when you're at NAV or certainly above NAV, we like to just see dividends. And I know you know that, Jeff. Just kind of a reminder for everybody on the call there. That's why we focus so heavily on repurchases a lot here at Value Investors Edge, is just because of where the stock's trading, right? It just depends on where you're at. So you mentioned the FSOs, and I'm glad you did, because that's a great kind of pivot point there. You extended the 10-year contract to 2032. The debt, as I understand it, is all going to be repaid sometime next year. So what's the potential there? Can you sign a new like 7 or 10-year debt profile, 5-year debt profile, bring in a lot of free cash? How's that work?
So I'll start that, and then I'll let Jeff go into the details a little bit. We do consider this asset has been bringing in, even in times when the tanker market is very soft. The FSO will throw off, even after paying the debt in 2021, something $10 to $12 million to International Seaways, and then once we've extinguished that debt in the third quarter of next year, then that rises to being over $20 million a year. So the FSO is clearly bringing in it's a significant source of stable cash flows for us. So it's a very valuable in our portfolio. That having been said, we will look at, exactly as you're saying, Jay, various ways to either monetize or put ourselves in position to extract more value from the FSOs. And Jeff, I don't know if you want to kind of go into that a little bit, or
well, I don't want to go into it too much, only in the sense that you've laid out the philosophy, and I would simply say, and well, first of all, we had a nice empirical study. Jay, you remember a couple of years ago, we had another kind of non-core asset joint venture, also based in the Middle East. It was a joint venture in the LNG space with Nakilat, and we sold it for a little over book value, $115 million, and the market cap of our stock went up close to $100 million, or right around there, the day after we sold it, which is like a little science experiment to see that non-core assets often aren't reflected in share price. So I think our partner and we both feel like there's a very high probability that this asset is probably not fully reflected in our share price. So as Lois said, we have lots of options, because it's a really great move having it. We're in a great position having it been extended. 20 million plus per year for 10 years. It's pretty easy to figure out what that's for. So we're just going to examine our options and see what, it could be financing, as you said, Jay. It could be, something where, it's more of the whole enchilada. So we'll look at it with our partner and come up with what we think is the best outcome, including keeping it.
Yeah, certainly. There's a very clear trajectory, easy to model free cash flow from that thing, from 2022 through 2032, right? And I don't want to say unfortunate, I guess just kind of annoying, is I'm kind of a hybrid between a researcher and an investor, but it is just an asset that I feel like, biased, I guess, because I own your stock, but I just feel like a lot of the other analysts just don't give you any sort of proper credit for that. I think it's gotten a little better recently, but I remember 3 or 4 years ago when you did the spinoff, I think we were the only ones out there that gave you any credit for your LNG venture and your FSO venture.
Absolutely, Jay, and in particular, on the LNG joint venture, it was fixed charter for life, and it was a very known equation, but the distributions were much smaller. On the FSO, we're talking about a substantive asset, and locking in that 10-year contract in the fourth quarter of last year, absolutely pivotal, for that, that joint venture, because it crystallizes the value.
Yeah, of course. There was, and feel free to, I guess, get ready to dodge or put on your safety belt. But there was a interesting, clause in the merger agreement, and it made its way into a TradeWinds article about, there being a potential for some sort of carve out special dividend in case, a certain joint venture was sold. Is that just standard merger boilerplate, or is there like, is there a there not to use like an
Yeah,
academic?
there's no there. It is, I think, a consideration, but it's, there is no there. That's really not even a story.
Okay, that makes sense. We had Euronav on the line a few days ago, and I asked Hugo that, and he gave me a little lecture about standard merger boilerplate. So just wanted to see it made it graced to the front page of TradeWinds there for a minute.
Yeah, it's more mechanical. It just, you had to take into account even a remote possibility if something were done. What would you do to adjust? It's true in a lot of other mergers, including one I think that they went through. So, understand people see things, but it's let's leave it that. It's going to be an asset that we will attempt to monetize during the course of in due course, but we're not going to rush into anything.
Certainly. I mean, there's no need to rush. You got free cash flow guaranteed through 2032. So take your time, please. Excellent. So, what I guess as we sort of get ready to conclude here, I do want to pivot a little bit and ask about those 3 new builds, the LNG dual fuels. What was some of the thought process behind that, and what sort of economics, what sort of return come with those?
So, the thought process behind that, Jay, those, I have to hand it to Shell. I think with, they're very forward looking, and for us, we would not have ordered a new building with a conventional engine. That would not have happened, and we would have been loath to build a dual fuel engine with the LNG and conventional capability without a contract. So for us, that was a position we had thought about quite thoroughly. And when the opportunity arose with a long-term customer to be able to execute these dual fuel vessels, we were right there for that. They will be 20 to 40% more efficient than these that are on the water today. That's from your most brand new build coming out of the yard right now to like a 10-year-old ship. That kind of a range, you're looking at achieving lower carbon emissions, and the price that we were able to lock those down at, those berths were contracted basically at the end of Q4, is already, as I mentioned, 10% in the money. So people will be and are ordering conventional V's at a very similar price, and that do not have the flexibility and capability that we have. And the way that the contract is constructed, we have a base rate with a profit sharing, and I'll let Jeff talk about that a little bit. And the one thing that that I do talk about on the profit sharing element, it is a monthly settlement in the contract, which is important for an owner because it allows you to capture the upside periods without having to give that back over a downside period within a year. And then I'll turn it over to, say one more thing before I turn it over to Jeff. Because these ships are so much more efficient, we model that we will be in the profit sharing, portion the majority of the time.
Wow, thanks, Lois.
Go ahead, Jeff.
Sure, and I'll try to keep it as simple as I can. Clearly, Shell, just with like any major customer, we don't disclose the precise terms of a long-term charter because that's competitive for them. But this is a win-win deal. Here's how it's sort of financially constructed or conceptually financially constructed, which is, there's a base rate that Shell will pay that in the 7-year charter that basically amounts to a daily rate equal to service the debt that they know, because they're pretty clever, and anyway, we're collaborative on what the options are for financing this thing. So at least these 3 vessels. And then on top of, so that's so they don't have to build it themselves. They farm it out to us. We do it. It's off their balance sheet, but they're paying us through their charter, the equivalent of the debt service that they would otherwise have to pay themselves. Beyond that, we have a profit sharing, as Lois said, that means that since they're operating the ship, they're under time charter, they're paying for the bunkers, which will hopefully be most of the time LNG. That's the point of the dual fuel. But when it's not as advantageous or not as available, it'll burn very little sulfur fuel oil. And with the eco nature of the ship and the LNG benefits, it's estimated, Lois has said publicly, to be at least $7,000 a day more efficient than a comparable 2019 ship or something like that. So with that, the profit sharing, I'll simply say it looks like highly likely that we will get. Well, Shell will benefit from their half of it. We'll benefit from our half of it, and it looks like a return is going to be double digits. So everybody's happy.
Yeah, well, we all like wins, right? How many wins can we get out of that? What sort of spread is there between, and this isn't contract specific, of course, but what sort of like day rate saving spread is there on an assumption? I know there's an assumption of how much the LNG costs and all that sort of thing, but how much day rate savings do you expect between what you just did, the dual fuel LNG, and say your standard benchmark block model 2010 VLCC?
Go ahead, Jeff.
Well, I just want to remember one thing. It's on time charter to Shell, so they will be operating the ship. They will be, enjoying the spread or not. But and also remember how strategic it is for them, because they're very committed to LNG bunkering as part of their overall LNG strategy, right? So that's really for them. Of course, it does affect our profit sharing, but back to you. I was just making it clear that we're not paying for the fuel. Our partner is, our customer is.
Right. Yeah. Just one of the reasons I asked that question is because you mentioned how there's like a profit sharing spread, and it's based on that, right?
No, absolutely. And what I would say is that if you're looking at a ship that is 10, 12 years old, you're talking about consumption of somewhere around, over 50 tons per day, something like 54 tons a day if you look at the Baltic routes. And, these vessels will have the equivalent of 33 tons per day. So you're talking about, 20 tons of consumptions for when you're steaming. And that's basically going to translate into something like 10 grand a day, right? Now you've got a lot more modern ships where then that's going to be more narrow, and Jeff was using that average of 7,000 per day.
Okay, that's very helpful. That's very useful. So we're looking at like a range of between like maybe 10,000 versus some of the older ships, and maybe versus like 6 or 7 versus some of the more modern eco ships.
Yeah, maybe it's even 5 on a super very modern vessel, but on average we're looking at about 7.
Right. Okay. And that is based on, these are round numbers, but is that basically based on $500 VLSFO and call it $8, $9, $10 LNG? Is there any sort of?
Well, we modeled lots and lots of scenarios, and I don't want to get too into it, but I think the numbers that we gave you, Jay, are a pretty solid mechanism for the purposes that investors need to know.
Right. Yeah. We're looking for round numbers here. So 5 to 10 is a good round number. We're not trying to make it too complex. We just that was the answer we're looking for. 5 to 10,000. Sweet. All right. So I think we covered it pretty closely. I did post something on our chat for folks on the call, and I'll post it up with this recording. But on Value Investors Edge, we have like a dashboard analytics platform that compares all the tanker companies together, looks at everything, looks at price and NAV, looks at enterprise value, looks at operational leverage, financial leverage, number of scrubbers, ships. You get the idea, right? And tankers are lower valued on average, which makes sense. It's a kind of difficult market now, but there's this massive step function gap between like Seaways' price to NAV and enterprise value to gross asset value. So with that as like the wind up curve that I'm throwing your direction, pretty softball. What else? Because I mean, the value is obvious, right? The company's cheap, but like, why else should investors consider buying International Seaways, INSW, versus the plethora of other tanker options out there? Why pick you guys?
Well, I would say, Jay, that, just take for, the body of work that we put together, over, heading into our 5th year here, and the constant effort to, improve the quality of fleet, make sure that we're operating safely and with very, very strong governance. Before that became a hot topic, with an eye on the future and, how much pivoting will need to happen. I think you use the word stewardship, which doesn't maybe sound so sexy, but I think is a very valuable characteristic to have, making sure that, we have the balance sheet to get through the cycle, and then what's the best way to allocate capital. And for the conversation to be able to focus as frequently as it does in the boardroom around capital allocation, I think it is a testament to a company that is hustling and running well. Jeff, did you want to chime in there?
Well, I certainly agree with everything you said, not surprisingly, but I'd like to add one thing. It's a little bit technical in terms of investing, Jay, but I'm sure your listeners would appreciate it. I think that there are too many shipping companies to pick from in the investment world, so to speak. If you look at it the way institutional investors who have, let's face it, a lot of influence on valuation, and if they've got 5 or 6 or 7 just tanker companies, let's stick on tankers, then it's hard to cut through the noise and get seen. You could have the highest quality company with the best ESG score, like Lois was talking about, and like we strive to be focused on capital allocation. But in order to get noticed and be sort of on the top 3 of the portfolio manager and buy-side analyst lists at the big hedge fund or mutual fund or whatever it is, it's hard to compete for attention and then investment. So like Lois says, you move up the leaderboard, get to $1 billion market cap, and then continue with the quality of the operations, the quality of the people, the focus on ESG, the transparency, which is part of ESG, but running a company a certain way with no affiliated companies, no guesswork, just Western style. So you combine that quality with scale, then I think we stand a very good chance of getting a lot more attention from those institutional investors, which is going to drive the valuation. So to all your listeners, I'd say come along for the ride.
Yeah, as we come out of the pit stop. I love it, Jeff.
Yeah.
All right. Well, let's hope we got a Ferrari on the track and not a Prius, right? So
yeah.
Let's make it happen. All right, excellent. Thank you so much, Lois and Jeff, for joining us for this event.
Thank you, Jay. It's always a pleasure.
Thanks a lot.
This concludes another iteration of Value Investors Edge Live. We just hosted International Seaways, CEO Lois Zabronki and CFO Jeff Pribor. We recorded on the afternoon of June 11th, 2021 at about 2 o'clock Eastern Time. As a reminder, nothing on a call constitutes official company guidance or investment recommendations of any form. I have a long position in International Seaways, stock symbol INSW. If you're listening to a recording at a later date, make sure you look for the latest disclosures.